So let's have a look at the sources and uses of funds for banks. So where do banks get their money from? Well, sources of funds appear in the balance sheet for a bank as either liabilities or shareholders' funds. And what banks do to try and attract the savings of surplus entities is they offer a range of different deposit and investment products with different characteristics so that they're attractive to these surplus entities. So where do banks get their money from? Let's start off with deposit accounts. So these are customers who deposit their money in a bank account, and these bank accounts might be a check account, they might be called a savings account. You can withdraw the money on demand typically, and you may or may not earn interest. We have term deposits. A term deposit is a type of an account where you deposit money for a period of typically 1 month to 5 years. And because you've locked that money away, you earn a higher interest rate than you would on a check or savings account. And generally, the interest rate is fixed for that period. A bank may also get money through issuing a negotiable certificate of deposit. So what the bank is doing here is it's issuing a security in its own name. The investor pays for that security by giving money to the bank. Because it's issued at a discount to the face value, the amount the investor pays now is less than the face value that is paid by the bank at maturity. And the maturity is anything from 30 to 180 days. And they're also a highly negotiable security, which means that if an investor holds a negotiable certificate of deposit as an investment, it can be easily sold to another investor. We also have bill acceptance liabilities from the point of view of the bank. So before we talk about that, let's just look at what a bill of exchange is. Let's say that a company issues a security into the money market. So what the company's effectively doing is borrowing money, and an investor is buying that bill of exchange, and the company will be required to repay the face value of the bill at maturity. Now, the bank can play a role in this by accepting or guaranteeing the bill of exchange. And the way that works is if the bank accepts the bill, then they're accepting liability to repay the face value of the bill to the investor. And then the issuer of the bill agrees to pay back the bank the face value of the bill plus a fee. So what happens by the bank accepting the bill is the bank is guaranteeing the flow of funds to its customers without using its own funds. And the bank charges a fee for this service, which generates funds for the bank. So that's another way that a bank can get money. Longer term debt liabilities. For example, a bank can issue a medium to long term debt instrument to investors in the form of a debenture or an unsecured note. And these are effectively banks borrowing money and agreeing to pay periodic interest and principal back at maturity. And banks can do this domestically as well as internationally. We have loan capital and shareholders' equity. If we start with shareholders' equity, commercial banks are typically listed corporations. What that means is these companies are listed on the stock exchange and they issue equity, such as ordinary shares, to receive funds from their shareholders. There is also loan capital, which is a source of funds that have both the characteristics of debt and equity. For example, subordinated debentures or subordinated notes. And what we mean by subordinated is that the holder of the security has a claim on interest, payments, or the assets of the issuer after all other creditors have been paid. So if you have a subordinated debenture or a subordinated note, you rank above ordinary shareholders, but your claim on interest payments or the assets of the issuer that claim is only valid after all other creditors have been paid. If we have a look at the uses of funds, let's take the example of a loan. If a bank gives a loan to a customer, from the bank's point of view, that is an asset. And the majority of banks' assets are loans that give rise to an entitlement to future cash flows. So what that means from the bank's point of view is if they give a loan to a customer, they will receive both interest payments and repayments of the principal for the loan. And this might be personal loans, this might be housing loans, it might be loans to business or lending to the government. So personal or housing loans, it might be loans to purchase a house, an investment property, they might be fixed term loans for a car. Credit cards are a form of personal finance. We have commercial lending, where banks lend to the business sector and, for example, other financial institutions. It might be in the form of a fixed term loan, which is a loan with negotiated terms and conditions. It has a period. Interest rates might be fixed or variable. There's interest payments at certain times and also the repayment of principal. We have an overdraft facility, which allows an individual or a business with an overdraft facility to spend more money than is in their bank account up to an agreed limit, and this effectively becomes a short-term loan. However, you will pay a fee for this service as well as interest on the borrowed amount. We also have bills of exchange. If we just talk about what a commercial bill, for example, is first, a commercial bill might be a bill of exchange issued directly by a business to raise finance. So what a business is doing is it's issuing a financial instrument to effectively borrow money, and banks can both accept and hold those bills. Now, if the bank is holding that bill, it is effectively lending money to that business, and that will be held as an asset on the balance sheet for the bank. There are also rollover facilities associated with these bills of exchange. And what happens there is the bank is agreeing to discount new bills over a specified period of time as the existing bills mature. So that what effectively is happening there is the loan is rolling over. And banks can also provide leasing. Banks lend to the government through investing in both treasury notes and treasury bonds, which are Commonwealth government securities. Treasury notes are short term, treasury bonds are medium to longer term securities. There are also state government debt securities. Now, because the government is quite safe, well, at least the Australian government is quite safe, these are low risk, low return investments from the bank's point of view. The bank also has other assets, such as their network infrastructure and also shares that they own in controlled entities.